They are going beyond domestic boundaries. Okay. And they are going to trade. They're going, opening up businesses or buying and selling in a foreign country. Okay. Buying and selling in a foreign country. The name given to it, international trade, international finance. Okay. Now, there is something called direct foreign investment. We will not be dealing with this basically, unless just we want to know why a country goes and invests abroad, or why foreign countries come and invest in India. Okay, so that is foreign direct investment. It is in India, it is called FDI, foreign direct investment. Okay, where India goes and invests abroad, and foreign persons would come and invest in India. Why do they do this? Why do they do this? Anybody? Give some reasons why there is foreign, or why does foreign companies come and invest, or India goes and invests abroad, which is called direct foreign investment and foreign direct investment. Why do they do this? What are the merits and what are the uh, risks involved? Anybody? Mention a few. I will compare with the text. In text, they are given plenty. I want you to think about it as if you have not studied. Even if you are not studied, you should be able to answer, right? So just think about, why would a company come and invest in a foreign country? Why are multinational companies coming here? Why did KFC come here?
Sir, some companies, foreign companies, goes to China and they establish their factories there because labor is
Yes.
one of the factors, cost effective,
Cheaper labor.
cheaper labor.
Like Nike. Nike
Like,
is not
yeah,
even manufacturing,
yes,
as
they
I
are
told you. They are just,
outsourcing,
they're
outsourcing.
involved in designing their product and improving their brand image. That's all. They are not doing manufacturing also now.
Yeah.
Okay, cheaper labor.
Then direct materials may be cheaper in that
Yes.
place.
So in other words, we can put all together as cheaper resources.
Cheaper resources. Okay.
Okay. Then
Climate,
climate, you can mention, it's not mentioned in the text. Favorable climate.
like for medicine company.
Yeah, it is quite a valid reason. Okay, climate. Because
And
India has one of the most favorable climates.
Sir, in Telangana now, IT companies are trying to bring
Where?
more in Telangana.
Telangana. Yes. Why?
See, they are inviting more IT companies or more industries to come there because they want to have better economy there in that particular space.
It will improve employment. Okay.
Employment.
So it improves employment of the host country. They call it host country because this foreign is a guest.
Yes.
Okay, in the host country. So you can mention that also, because this can come for an essay. The reasons for foreign direct investment. Okay. Favorable climate is a good point actually, because they may not be able to do a particular business in their home country because the climate is not favorable. Okay, for that particular business. So probably they would go outside and do that business. Okay. For example, ice creams may not sell in a cold country. Okay. I was the only guy in Kazakhstan who used to eat ice cream in the cold when it was minus. People used to look at me so strangely. And other thing, at that temperature, the ice cream does not melt. Okay, it will be hard as rock if you take a chocobar or something like that. Remember, it is hard. It is not melting only, and the weather around is cold. So, and all cool drinks are kept outside the fridge during winter. Okay, and nobody takes it during winter, anyways, except crazy fellows like me. Okay, so favorable climate in a foreign country improves employment in the host country. Then what else?
Sir, large market potential.
Larger market. Yes, yes. Larger market. So a sort of diversification. Diversifying into another market, not the products. Okay. Okay. Then there are plenty of reasons.
There are some companies, they cannot directly market in their in that
Hmm.
foreign investing country. So
Hmm.
they start a plant in that place for AC marketing.
No, you know what they do?
Yeah,
To get
like
the exchange fluctuations.
yeah, okay.
Okay, exchange rate fluctuations. Suppose they are buying regularly from a foreign country. Okay. If India is buying regularly from foreign country, it is exposed to exchange rate fluctuations, is it not?
Yes, yes.
Instead of that, if it opens a factory in that country,
Yeah.
okay, then and gets the goods directly from that country to India, okay, it doesn't have to worry about exchange rate fluctuations. So that's one of the reasons to mitigate exchange rate fluctuations. So it's a sort of a natural hedge.
Mm.
Okay. Then there might be monopolistic restrictions in the home country. Monopolistic restrictions in the home country. That means what? Maybe if they expand in the home country, they become a major market power and there is restrictions. The government restricts monopoly. Okay, because monopolistic corporations, they would generally eat up the smaller factories. In the sense, they would snuff out competition. So there are something called antitrust laws, which is very strict in some countries like US. Okay. So they would actually go to another country where there are no so much of restrictions. Okay. Sometimes a good infrastructure also attracts foreign investment. Like, like in Telangana, for example, their infrastructure is much better than Bangalore or even Kerala or somewhere else. Kerala infrastructure is horrible if you ask me, right? The risks of foreign direct investment is political risks. Okay, change of government, right? And maybe what you call culturally, the society may not accept, like it happened for KFC in Bangalore. When it first came, the farmers protested and they actually stormed into the KFC restaurant and threw out the plates. This happened in the 80s. Threw out the plates of the customers who were eating. And then police had to come and intervene. And for a long time, police van was outside KFC. So there could be cultural, religious issues which oppose foreign direct investment. Okay. And the foreign company who is opening up in India should be very sensitive to the local culture. Otherwise, it can be disastrous. Now, for example, McDonald's markets beef a lot in China. Beef burgers are selling like hotcakes there. It's selling very well. But they don't do the same thing in India because they are sensitive to the uh, people's religion, culture, etc. Okay. So that should be taken care of mainly. Okay. Financial risk would be there. There could be, the foreign country might have either favorable interest rates or unfavorable interest rates. Favorable means it's one of the advantages, but it could have unfavorable high interest rates compared to the home country of the foreign company. Okay. So these are some of the risks and advantages of foreign direct investment. Okay. Also, availability of foreign technology. Okay, if you go and invest in a developed country, the technology is better there. Okay, so that kind of things would be applicable. Okay, cheaper labor and cheaper resources will end up giving you higher profit. Okay, yeah. So this is the reasons for direct foreign investment. You can get an essay question on this. More than multiple choice, an essay can be asked on this. Right. So foreign investment could come in the form of a franchise also, like KFC, McDonald's. Okay, this is foreigners investing in our country, is it not? Right. So many foreign, especially food franchises are coming in a lot. Okay. Right. Then another way, if at all that foreign direct investment is not possible, what would happen? Foreign trade would happen. International trade would happen. Okay. Now, international trade is actually having one big disadvantage, which is exchange rate. Okay. Sometimes there is demand for the product, but exchange rates makes it expensive, which actually is disadvantageous sometimes. You see, what will happen one day? I'm thinking, okay, the whole world will have one currency. That's what I feel. Okay, then there is no question of exchange rate fluctuations because that is spoiling the trade between countries. Okay, that's why government has to intervene many a time. Okay, so like many European countries like Italy, France, Germany. Okay, Netherlands also, I think. Okay, Netherlands and which other European country? So many other European countries got together.
Belgium, sir.
Belgium. Got together and in 1999 or 1998 got the euro. Is it not? Right. Why did they do it? Because of exchange rate fluctuations. Britain was not involved. I think Switzerland also not involved. Okay. Otherwise, they all got together because they didn't want. Otherwise, before that, this was French franc, Deutschmark, Italian lira. Okay, so they had their own currencies. They all grouped and got into one. So there was a talk during that time only, that is around 1998, this happened. Okay, it was planned much before, but it materialized in 1998. Now it's going well. Okay, before euro value was lesser than the dollar, now euro is more than the dollar. Now, even the Gulf countries had this plan. Kuwait, Bahrain, Saudi Arabia, Kingdom of Saudi Arabia, Dubai, I'll call it United Arab Emirates. Okay, and various other Gulf. Oman is not Gulf.
Sir.
Is it included in Gulf? I don't know. Okay, maybe.
It's in GCC, sir.
It's GCC, is it? Okay. So all these countries, they wanted to get together and form their own currency, but it has not materialized still. Okay, like that, groups are going to form their own currency, one currency, and then the whole world, one day, I suppose, 1,000 years from today, okay, it will take time. I feel 1,000 years from today, it will all be one currency. In our lifetime, we saw one happening, which is euro. Okay, because of exchange rate fluctuations. Now, what are the reasons of exchange rate fluctuations? I will list out. Okay. I will list out some of the exchange rate fluctuations. Why? Factors that affect exchange rates. Even governments find it very difficult to predict which way the exchange will move. Okay, there are some of the factors which I'm going to list down here. It could be a combination of these factors, or it can be a single factor which causing exchange rates differences, okay, fluctuations. But generally, it's a combination of the factors, not only a single factor. One is the pure thing, demand and supply of the currency. If the currency is, there's more demand of a particular currency in a country, like dollars, for example, people are buying dollars, sometimes for speculative purpose, thinking that dollar will never go down. So they are just buying dollars to store it. And as a result, demand goes up, the price goes up. So the Indian rupee would depreciate against the dollar. They'll have to pay more for the dollar. Okay. Then comes inflation. Inflation. Generally, the country with a higher inflation would see their currency devaluing. Okay. A currency with a higher inflation would see their currency devaluing against a country which has lower inflation. For example, between US and India, inflation in India is higher. If it gets much more higher than the US, its value exchange also would get devalued against the US dollar. Okay. Got it? Any questions? Third is interest rates. Now listen carefully where interest rates are concerned. Suppose one country has increased its interest rates. Okay. Its currency would appreciate with respect to the other country. Okay. For example, suppose US interest rates is 3% and India has increased its interest rates and made it 10%. Its currency would somewhat stabilize against the US. Why? Because US people will bring their dollars to India to invest in the higher interest rates instruments. Okay, they can buy bonds probably, or they can just put bank deposits. Okay, for FDIs, foreign institutional investors would actually put in their dollars. So supply of the dollar goes up. Okay, supply dollar goes up, and Indian rupee would get stronger a little bit. Okay, this is one of the ways the government controls exchange rates. Okay. The government actually, most of the governments of industrialized nations, they would interfere in the exchange rates. They wouldn't allow demand and supply to do its job. They wouldn't allow what is called a pure float. Pure float is let the demand and supply decide what exchange rate will be. But government will put in their legs. Okay, they will interfere, which is called managed float or dirty float. Okay. Why? Because the government is interfering in the natural demand and supply to decide the exchange rates. They are interfering in it. Why? Because if they don't interfere, they feel that their economy will go very bad. For example, if RBI doesn't take measures to control exchange rates against the US, we are in a net importing position where oil is concerned. Is it not? We are importing more than exporting. So what happens? We'll have to pay more Indian rupees to buy oil, because we have to buy oil in US dollars. Okay. So we'll have to pay more. It becomes more expensive. And if oil becomes more expensive, everything becomes expensive. So the government interferes and tries to control the exchange rate. Then It's called balance of payments. Okay. Then comes, future expectations. Suppose the public has got, future expectations on a certain currency, that euro is going to increase in price. One lady in our office, she did a very interesting thing. She took loan from office. Okay. She took loan from office. She was repaying it from her salary. Okay. But she has invested everything in euro. Okay. Our office is to give interest-free loans. Okay. My boss was kind-hearted chap. He used to give interest-free loans, thinking that employees are in difficulty. Okay. So they need loans. So this lady went and purchased euro. And when she had to leave the company, actually she got a better job somewhere. She had to leave company. She had to settle the loans. She came with a great bunch of euros to settle the loan. Okay. My boss was shocked that she has invested everything in euros. So that is why she invested. She had the future expectation that euros will go up in price. Okay. So when the future expectation is that euro will go up in price and they start purchasing, the demand for that increases, and that currency, euro, for example, would appreciate against the local currency. Okay. Got it. Then coming to Abraham's doubt, the balance of payment situation also would affect exchange rates. So what is the balance of payment? And what is, basically we talk about the trade account deficit or current account deficit. If there is a deficit, it means that imports are greater than exports. So what we owe other countries is more than what we have to get from other countries. India has always been in a deficit for a very long time. You would be surprised, even US is in a current account deficit. Few countries have got current account surplus. That is, their exports is more than imports, which is China. I think China. You can Google it up. Okay. Otherwise, most of the countries are in a deficit. Okay. So what happens here is, when the imports are more than the exports, the government sometimes would purposely devalue the currency. Okay. It has happened in July 1992. Okay. They purposely devalue the currency so that exports pick up. See, when the currency gets devalued, what happens is exports become cheaper. A foreigner has to pay lesser dollars to buy Indian goods. Okay. So exports will pick up. Of course, imports will also become expensive, but they are hoping that the exports would surpass the imports. Okay. And the country would benefit. So some countries, they would actually interfere with and devalue the currency. India has done that in order to boost exports. Okay, and improve the balance of payment situation. Okay, by, it doesn't improve drastically because imports is also going to get expensive, but they're hoping that the export market will beat the imports. Okay, so yes, the next one is the government intervention. Government intervention. They actually control exchange rates. Okay. Like this, as I showed you, to improve the balance of payment situation. Got it? Any questions? Any questions so far?
Sir,
You'll be
can
asked multiple choice questions on all these, which I will be doing after the break.
Sir, one question.
Yeah.
Can you just describe the pure float?
Pure float is very simple. I think very few countries adopt that. They let the demand and supply decide the exchange rate.
Okay.
Without government intervention. Okay. For example, if there's demand for dollars, the dollar goes up in price, right? Right. Suppose the dollar is $1 is rupees 80. If the demand goes up, okay, soon it will become expensive. It will become rupees 83. Okay, Indian government would interfere in this and try to bring down the price of the dollar. But in some countries, they would allow it to go up. If it's in demand, let it be expensive.
Okay.
Okay, if it's not in demand, let it fall off. They are not going to be bothered. Okay. Right.
Okay.
But nobody asked me, how does the government interfere?
Yeah, this is.
I'm just telling the government will interfere, but how do the government interfere? I'll explain. See, currency markets does not have one particular place, like a stock market. Okay, there's not one particular platform for currency markets. There are several nodes for currency markets. Banks sell them, travel agents sell them, and exchange dealers, currency dealers sell them. So it's all over. It's spread all over the country, right? It's not one place like a stock market. They come and buy and sell currency, right or wrong? So companies like ONGC, for example, okay, you know what's the demand for dollars in a day? Up to $400 million they require to import oil. $400 million in one day, they require this. If they enter the usual currency market and purchase this, just imagine what the dollar price will go. The dollar price will go through the roof, is it not? The demand for dollars will go so much because these people want this many dollars in one day. This is the demand per day. Okay. So what RBI does in order to control this demand, they would open a special window and they would call ONGC, don't go to the market to purchase, come here, come to RBI and purchase this 400 million. RBI would give them at a cheaper cost because RBI has got dollar reserves. You understood? Through these reserves, it will control the exchange rate. So when ONGC comes to RBI to purchase this, the demand for dollars is not so much in the market. RBI will give it at a lesser price, $1, maybe rupees 80, it will give. And thereby stabilizing the dollar demand. But in the meanwhile, RBI's foreign reserves are getting depleted in the process of controlling the exchange rate. Did you get me?
Yes, sir.
They open a special window for huge demands of dollars, thereby not allowing them to get into the market and raise the dollar price. Okay. So this is how the government, with the help of its foreign reserves, it will control exchange rates. Recently, when Raghuram Rajan's time and everywhere, the dollar was really appreciating. So they were controlling it in this way. One thing is they have political pressure also. Okay, when the dollar is getting expensive, some people have this notion that if the dollar is expensive and rupee is devaluing, it's a bad sign for the economy. But it is not actually. A weak dollar is not a bad sign because exports will increase. Okay. The last one is income levels between the two countries. Now here you have a surprise. Okay. Relative income levels would also affect exchange rate. That means if one economy is doing good, economy good, okay, and income good, economy not so good, maybe slow, and income less. This is not income, it is good, income good. Okay, income is less here. Which currency would increase? Which currency would appreciate? Which currency would depreciate? According to you, which currency would appreciate and which currency would depreciate? For example, let us talk about, this is USA, this is India. Okay, which currency would appreciate? Which currency would depreciate? Anybody? Yes.
Sir, if the economy is good, income is good, that means that currency should be stable, right? Strong.
Strong. Anybody else?
Indian currency will appreciate, sir.
Why?
Its value goes up because US currency getting stronger.
So how will Indian currency appreciate if US currency getting stronger? US,
That means the exchange rate, sir. It will grow. $1 will go to 85, 90, like that.
no, it's wrong. I'll tell you what. That's why I told you there's a surprise here. Okay. If our economy is doing good, okay, there is a chance that its currency would depreciate against a country whose economy is doing bad. I'll tell you why. Okay. Now, income is less in India, right? Okay. Its imports will become less. Imports will lag behind exports. Imports will become less because the country is not doing well. Okay. If imports becomes less, the demand for the foreign currency will get less. Okay. So when the demand of the foreign currency like US dollars gets less, the US dollar will depreciate. It will go down. Like from 83, it will go down to 80 because nobody is demanding it. Just I'll give you an example. Supposing the economy is very bad in India. Okay. People are losing their jobs and everything. Will they go for foreign trips? Because if they go for foreign trips, they will buy US dollars, right? Okay. And the US dollar demand would increase. But now the economy is slow, they're losing jobs. Okay. Income is less. Will they go for foreign trips? Will you go to for a foreign trip, Robert, if this is the case?
No, sir, I will not. I will not spend.
You will not spend. If the economy is bad, you will not want to spend. Lakshman, you will want to spend on a foreign trip?
No, sir.
Yeah, like that, the whole India will not want to spend. Then what will happen to the dollar demand? It will go down. Imports will become lesser. They will not start importing, imported chocolates. Everything will stop. And the Indian rupee would appreciate against US dollar. Not because Indian rupee is getting stronger, US dollar demand is getting lesser. The main reason for a currency to appreciate is the demand for that currency. The main reason. Okay, when imports lag behind exports, the currency's demand, foreign currency's demand is going down. It would depreciate against the Indian currency. This is the surprise I told you. Generally, you think when an economy is doing good, its currency is going to get stronger. Okay, but it is somewhat opposite when the imports become less due to lesser income, income and the economy is slow. Got it? So this is the surprise. Okay, so remember this. Anyway, exchange rate would fluctuate or get affected with a combination of these factors, not for a certain factor. The government and economic experts cannot predict which way the exchange would move. how it will swing. Being such great learned people and knowing all the factors which affect, they still cannot predict which way it will swing. That's what it becomes very difficult for them to control the currency exchange rates, because they don't know which exact factor is happening. Okay. But yes, when the government and the central bank interferes, they deplete their foreign currency reserves in order to control it. Okay. Right. So this is about it. Okay. Now we will do after. These are some of the factors which have been given in the text that actually affect exchange rates. Now I'll show you our newspaper cutting. Generally, it's considered that a weak rupee is bad news. Okay, but I told you sometimes the Indian government has purposefully devalued the rupee through an official announcement. It happened in July 1991 something, when the official rate was $1 is 17 or 18 rupees. Okay, it became, the government announced that $1 is going to be 25 or 26 rupees. They intentionally devalued it in order to boost exports and adjust the balance of payments. Because balance of payments, they were having a huge deficit where imports were much greater than exports. So by devaluing the rupee, the international trade will get boosted. The exports would go up. Okay, and it would narrow the gap. Of course, imports will get more expensive, but they were hoping that exports would overtake the imports. Okay, and they did adjust it to a reasonable level. Okay, see, this is a nice, interesting article I got in the newspapers. That time, $1 was 80 rupees. Why an 80 rupee dollar isn't a sign of weakness? Okay, so what he is telling, this particular person, Swaminathan, okay, he is telling, let it slide, let it become weak, because the rupee is actually getting too strong, he says, thanks to the RBI intervention, and this can hit India's exports. Exports will become more expensive. See, in the world over, people tend to view a strong national currency as a sign of virility. Okay, virility. That means sign of strength. He says that is good sexology, but it's poor economics. The exchange rate should be competitive. Okay, that often requires a weak rupee. He's saying a weak rupee would be beneficial. Okay, it's not a sign of weakness. So if you look at it, he says here, I've highlighted the main point so that you don't read everything. Read the highlighted one. In the last year, the rupee has fallen 5% against the dollar. But euro also has fallen faster, 7%. Yen has 14%, it has fallen. So India actually, it has appreciated, not just in these three currencies, but even Chinese yuan. Okay, so he's saying that the Indian currency should be competitive because other currencies are falling against the dollar. So their exports are getting cheaper and India's export market is getting weak. He's saying, though it appears to be strong, because it's political pressure, basically. Okay, it's political pressure because the country views that a weak rupee is weak economy. Okay, and they will put pressure on RBI to strengthen the rupee, and then the exports will get hit. You understand what I'm telling? See, because of that, because RBI trying to strengthen the rupee, the current account deficit has widened. Okay, has suddenly widened. So that is what he says, is a problem. Okay, but one good news is foreign direct investment has been strong. So that, that also again, it would strengthen the rupee because they would come with their dollars. Okay. So anyway, what they should do is let it slide. Let market forces determine. That is what pure float is all about. Let market force determine, because ultimately exports will become cheaper. So since India's rupee has fallen less than other countries' exports would be better than India. So it's not competitive. You understand? So that is a new lesson, what you can see here, opposite to what people think. Okay. But of course, getting too weak is also not good if it is going to affect imports a lot. But it is not a sign of weakness. Okay. See, that's what he says here in this particular place. In theory, RBI is an independent institution. It shouldn't come, okay, under the influence of political pressure. That's what he says here. But in practice, it's a government arm. One hopes that the RBI is not under political pressure to avoid crossing what the public may view as a major threshold of rupees 80 to the dollar. So it's not such a big threat. Okay, that's what they're trying to say here, which is very correct. He's a very logical way he has explained this. And it for your subjects, for your syllabus, it makes you understand better about currency movements. Okay. Not to view it as bad news every time. Okay. So that was about it. Now we will do some multiple choice questions. Okay. Please do question number 1.
A, sir.
Option A, sir.
Option A.
Option A is correct.
Option A. Yeah.
Option A is correct. Why? Pooja, explain.
Sir, because highest interest rate attract foreign capital and which increase demand for the currency and
for the
which
local
impact
currency.
to, yes, sir, appreciation.
Correct. Because foreign dollars or whatever foreign currency would start pouring into the country to take advantage of the higher interest rates. Okay, then the supply of foreign currency would increase and the demand for the Indian currency would increase. Okay, because they would buy Indian rupees, they would exchange their foreign money for Indian rupees, and then they would invest, they would put it in deposits, buy bonds, etc. And the Indian rupee or the local country's currency, which raised interest rates, would increase in value. A is the right answer. Right. Question number 2. This is little tricky, huh? Just try to answer carefully. Robert?
Answer C, sir.
Answer C. See, the concern here is the opposite. The currency is going up in value. Short-term speculative rise in the worldwide value of the domestic currency. So it is going up in value and it wants to be moderated. The bank wants to bring it down. It happens in Japan. Mainly Japan is very concerned about the rising price of the yen. If yen gets expensive, you know what happens? They export cars. Toyota is in great demand in the world. Okay. So what happens is the demand for Toyota goes down because yen is very expensive. A foreigner has to spend more dollars to purchase the yen. So for him to purchase Toyota will become very expensive. So Japan is really concerned about the rising dollar. Rising yen. So they would try, the Japanese central banks would try to bring down the value of yen. In India, it's the opposite. That's why you're finding this question strange. In India, what happens? The Indian government is concerned about the falling rupee because of political pressures or whatever may be. Okay. So they would resort to a different strategy compared to Japan. Okay. So if what Robert says, if they raise domestic rates, what would happen? The currency, the domestic currency would go up in price, is it not? Because foreign currencies would start flowing in to take advantage of the increased domestic interest rates. So this speculative rise will go up further. They want to moderate it. They want to bring it down. So this is not the answer. Then some people answered D. Buying the domestic currency is nothing but selling the foreign currency. Is it not? Because when somebody buys dollars from you, what are you going to do? You are actually getting in dollars. Okay. Right. Right. You are actually getting in dollars. And what is happening? Buying domestic currency. Okay, now 1 minute. Buying domestic currency is selling dollars, is it not? Because whatever is coming in, you're buying. Okay, so for example, whatever is coming in, if rupees is coming in, you're buying rupees, you're selling dollars. Right?
Yes, sir.
So in this case, what would happen? The dollar price would decrease. If the government does this, the dollar price would decrease and the rupee price would increase, is it not? Okay, that's what the Indian government does to stabilize the rupee. Okay, they supply US dollars to ONGC and everybody else. So when they're doing that, they're buying the domestic currency, right? The ONGC is coming with Indian rupees. The Indian government is supplying dollars to bring down the dollar price. Okay, so here what has happened? The domestic currency is increasing. They want to bring down the domestic currency. So this is not the answer. Buying domestic currency is selling foreign currency. So this is not the answer.
So sell domestic currency in the foreign exchange market.
This one would be the right answer.
B.
Yes. Because when they're selling domestic currency, what are they doing? They're buying foreign currency. They are buying foreign currency. The government is buying foreign currency. Okay. So what will happen? The foreign currency demand will go up and the local currency will fall. Is it not? You understood the logic?
Yes, sir.
Right. This question, that's why I told you is very nice. If they're selling domestic currency, the domestic currency is going out, what is coming in? The foreign currency is coming in. That means they're buying foreign currency. When they buy the foreign currency will go up in value compared to the domestic currency. Okay, the domestic currency will fall. That's what the government wants here. Like the Japanese government. Okay. We find this question strange because we don't face this situation. Rupee is always sliding. Okay. Selling foreign currency, no. Selling foreign currency will increase the supply of foreign currency and would again raise the price of the domestic currency. Okay. Got it?
Clear, sir.
You're sure to get some questions in this area? I think at least one. Question number 3, the last question for the day.
B, sir.
B. B or D?
B, sir. No, B.
B for Bangalore.
Yes, sir.
Okay. Anybody else? Anybody else? Yes? Only Pooja? Nobody else? Come on. I told you the
I'm
theory
also
part.
going with B, sir.
B for Bangalore.
Yes, sir.
Okay. Robert? Shraddha? Shraddha? Lakshman, explain, please.
Sir, when a country has a slower economy and a slower growth rate of income, obviously they won't import. That time, that foreign currency will not have the demand. So, if the foreign currency is not having demand, obviously our local currency will have will
Very
get
well
some
explained.
appreciation.
Very well explained. Yes, D is the right answer, and it will tend to appreciate. Okay. He's asking what would make it appreciate. So B is the right answer. If A has a higher inflation rate, A will depreciate, not appreciate. Okay. If B has real interest rates higher than country A, then B's currency will appreciate and A's currency will depreciate because people will invest in a country with higher interest rates. If B switches to a more restrictive policy, monetary policy, B's currency would appreciate as compared to A. Okay. Restrictive monetary policies controlling the supply of country B's currency. Okay. This the bank does in various measures. They increase the cash reserve ratio. Okay. They would increase the interest rates. Interest rates is also restricting the monetary, it's a restrictive monetary policy because lending rates also would go up. Okay. And people will not borrow money so much. And the supply of the local currency is reduced. So the currency would actually tend to appreciate. Okay. So all others would make B's currency appreciate and A's currency to depreciate, except B. I hope it's clear, everybody. Right. See you.